Why is the CRT model working for others but you keep blowing accounts with it? Because ICT didn't tell you the whole truth. The CRT, the CIT, the rejection block are traps. If you don't understand this one stupid candle behavior, guys. I'm Victor Snow from Trading from the Soul, where smart money is simplified. Like and subscribe so you don't miss out on future videos. I'ma keep chasing. So what is the CRT model, guys? It is a trading concept that focuses on analyzing the price movements within the range of individual candlesticks to understand market dynamics and predict future price actions. A range is what very crucial in CRT model. And what is this range, guys? It is the difference between 2 points in the market. That is, from here to here is what a range. So the CRT model focuses on the behavior of other candles around this range candle. ICT traders, our main aim is to predict the next set of candles. This video builds up on already out video. I finally cracked the ICT CRT model. Watch that before this video. So to be able to anticipate the next set of candle, guys, you have to be able to choose your CRT model candle, which is your one stupid candle. Then you wait a sweep of the range low for a bullish CRT and the range high for what, a bearish CRT, and you target the opposite side of the range as your take profit level. This is your one stupid candle, can be picked from any time frame, guys, and this is your range low and this is your range high. Your candle range low is the lowest our one stupid candle got to before it was created. Can you see? This is the lowest it got to before it was created, while the high is what the highest our stupid candle got to before it was created, and this is the highest it got to, guys. This next is what, wait for a sweep of the range low for a bullish CRT or high for what, a bearish CRT. Can you see what the next candle swept this range candle range high? That means we are what anticipating a bearish CRT, guys. And can you see after that price action delivered price towards this range low? Let's take a look at this example. This is our one stupid candle. This is the range low and this is the candle range high. I see sweep the candle range low. That means we are expecting a bullish CRT. See after that price action delivered price toward the candle range high, guys. I would want you guys to take note that our candle range low and candle range high is otherwise called what, draw of liquidity, guys. Draw of liquidity is the market's natural tendency to move towards pools of liquidity, which is where others are definitely resting at. So we have what, liquidity resting above this candle range high, this draw of liquidity, and below this candle range low, draw of liquidity. That means it's what, each of them attracts price to each other. Price action will definitely take out this liquidity resting above this level, and it makes a displacement from that level to the downside once these orders resting above here are consumed, and the cycle repeats again. So why is liquidity important? Liquidity is just like when you don't eat a food in a day. Do you notice that you won't be able to go about your daily tasks? You won't be able to do something. You'll be weak. You will not be able to move. So as without liquidity, our trees won't be able to move. So one thing I want to highlight is what, this one stupid candle can be picked from what, any time frame, guys. So we're going to be using the 4-hour time frame from now onwards, because of this trade I took at the end of this video is from the 4-hour time frame. So let's look at how we can be able to get higher probability CRT models, because not all CRT models are higher probability. So to get higher probability CRT, we use what we call what, timing, guys. Each candles right here are all 4-hour candles each. That is the 4-hour time frame now. And in our 4-hour time frame, go to your 4-hour time frame, you notice that 4-hour candles are only being formed 6 times a day in the markets, right? They are being formed by 1 a.m., 5 a.m., 9 a.m., 1 p.m., 5 p.m., 9 p.m. or Eastern Standard Time. When making your settings, you make it New York. So it's being formed in the morning, afternoon, and night. So only 3 out of these 6 timings gives us a higher probability entry, which are the 1 a.m., the 5 a.m., and the 9 p.m. That is, that one stupid candle you choose must be formed at this time period selected here. From this example, let's count this is our 4 a.m. candle, this is our 5 a.m. candle, guys, which is our one stupid candle, guys. I see our one stupid candle was formed at 5 a.m. our timing, which gives us a higher probability setup. We move 6, 7, 8, and 9 a.m. candle. One quick thing I would want you guys to note is we want our stupid candle that was created to be swept at the remaining 4-hour time period. So this remaining 4-hour time period, 9 a.m., 1 p.m., 5 p.m. let it sweep this 5 a.m. candle created, and in this scenario it was our 9 a.m. candle here that swept this 5 a.m. candle, which after that we traded to the downside. Can you see how we get our higher probability setup, guys? Like and subscribe if you're learning something new from this video. Let's take some examples. In this video, we're going to be using the 5 a.m. candle and 9 a.m. candle. Our single one candle formation, we're going to be looking at it from 5 a.m. and we want our sweep to be at 9 a.m. guys. This example, this is our 1 a.m. candle. The next candle will be formed at your 5 a.m. here now, which is single candle formation here, which will mark our candle range low and our candle range high. So we move 5, 6, 7, 8. The next candle will be formed by 9 a.m. 9 a.m. candle was the one that swept this candle range low, which immediately delivered the 1 p.m. candle for our candle delivered price to this candle range high draw on liquidity. If you find it difficult to understand this concept, I finally cracked the CRT model. It's easy. Now, how do you know exactly where to place your entry after this guy was swept? We use the CiT model, which is candle impulse theory, guys, which is a sudden price movement in one direction accompanied by high volume and momentum. It is simply tendency of a candle to move in one direction with large momentum. It has a tendency to retrace this 50% level before it can be able to move to the upside. Can you see this guy retraced this 50% of this previous candle before it moved impulsively to the upside, guys? The idea behind all this is the institutions will always want to buy at the cheapest price in the market, which is the discounted level. Just like when you go to the market to buy something, wouldn't you want to buy at the cheapest price possible? Drop your answer at the comment section. How can we use this for our entry? Once this 9 a.m. candle was formed, we get our Fibonacci through. We'll mark from the low to this high of this 9 a.m. candle, and this 50% zone is our discounted level. We're gonna make our entry at this discounted level, stop loss below this level, and we'll target this candle range high for our take profit, guys. I would want to know, do you currently use this in your trading? And give me a thumbs up and subscribe if you're learning something new from this video. So guys, for this example, this is our 9 p.m. candle, our 1 a.m. candle, and this is our 5 a.m. candle, which is also our one stupid candle range low, candle range high, and it was our 9 a.m. candle that swept it or mark out towards Fibonacci 2 from the high to the lowest and get our 50% level. We make our entry here, stop loss above here, and we sell to this candle range low, and it was our 1 p.m. candle that delivered price to our take profit level, guys. I've used this 5 a.m. to 9 a.m. candle to catch a lot of winning trades last month. So let's take a look at this. It was our 9 a.m. candle that swept this 5 a.m. candle range low, mark out fib from the low to the high, 50% level. After price action, retraced down to here, went a little bit lower, it's moved to our take profit level, which is this candle range high, guys. And for this example, 5 p.m. candle, 9 p.m. candle, our 1 a.m. candle, and our 5 a.m. candle that we used. The candle range low, guys, the candle range high, and our 9 a.m. candle was the one that swept our candle range low before it moved price to this candle range high. Someone watching me will ask, Victor Snow, should we enter from this level? The answer is no. Once price have gotten to this candle range high, there is no more draw on liquidity in the market. Markets will not be able to move if we try to enter from the 50% level of this 9 a.m. candle, guys. So an entry from here will be what's wrong. If this video helped to improve even a little as a trader, a thumbs up and a subscribe right now would be nice. And always leave a comment on topics you'd want me to cover next. It helps us make better videos for you guys. And if you're still struggling with trading, I just launched a free 3-day trading course. Link will be at this video's description. If you love this video, you will definitely love my stupid 1 candle strategy that makes 10k a day. See you guys there right now.
They tell me that I'm never gonna make it. They want me to do something that could make sense. They hate when I keep dreaming I'll be famous.